I hope everyone had a fantastic Halloween. I know we all sure did. And thanks for joining us for the market update for the month of October. The US market, as measured by the S&P 500, was up 2% for October. Canadian stocks were up just a little bit, 0.8. Gold gave back a little bit of its gains, but overall for the whole year, the Canadian market's actually been better than the US market. And the European and Asian stock market, as measured by the MSCI EFI, was up 1.67. So overall, another positive month for the market. I'm going to pass you over to the guys, and they're going to go in and have a little bit more of a deeper dive into everything. Take care.
David, what was the story around growth and inflation in the markets?
Well, in North America, we saw inflation come in around 3% again in the United States. So inflation is definitely slowing. There hasn't been an inflationary spike in the US, which is what was feared back in the springtime when tariffs were first announced. CPI is running around 3% year over year in the United States. So for the central bank in the US, the shift is focused away from inflation concerns more towards what monitoring growth forecasts for the economy. In Canada, it's been a similar story. Inflation is around 2% year over year. So again, inflation is not so much of a concern for Canada any longer. The central bank in Canada, the Bank of Canada, is looking much more at economic growth. And, we have seen some concerning trends around economic growth in Canada. Economic growth is now forecasted to just be 1% in 2026 based on Bank of Canada forecasts. And a lot of that has to do with trade concerns, tariffs, eating away at certain manufacturing sectors, especially in Southern Ontario, as far as it relates to Canadian GDP growth in the future.
With interest rates, both the Bank of Canada and the Federal Reserve had meetings in October. The U.S. Federal Reserve Board did elect to cut their rate by a further 25 basis points, marking the second straight cut in as many meetings. Now, during that meeting, they did cite that softening labor market and slowing economic activity amid trade tensions as being the driving force behind making that decision to cut their rates. But in the meeting, Jerome Powell, the U.S. Fed chair, did also state that a further rate cut in December was not a guarantee, that they're continuing to monitor economic data, and that in their look forward, Fed officials were a bit divided still on their outlook for the labor market and inflation on a go-forward basis. In Canada, at our Bank of Canada meeting, they also cut our interest rate by 25 basis points, just like the U.S., marking a second straight rate cut. Just like the U.S., a softening labor market and slowing economic activity due to our exports being down amid trade tensions with the United States being driving forces behind that. All that said, the Bank of Canada does believe that it has reached its goal in cutting our interest rate in order to combat inflation, and they feel they've done their part to bring inflation back to their target of 2%. Looking at other data, Canada's economy did shrink by 0.3% in August. Again, trade tensions with the US being a driving force behind that as we export a lot of products to the United States. The Bank of Canada may be done lowering its interest rates to help combat that, but it's not done looking at all the data. It will continue to monitor on a month-by-month basis to see how our economy is doing, how the labor market is doing, and see if there is anything they need to adjust at those times.
2025 started the year certainly on shaky legs as President Trump threatened tariffs, then eventually rolled out his, Liberation Day address in early April, where he would be, tariffing all of his major trading partners. The market panicked. Risk assets sold off significantly, with the S&P 500 being down 21% at one point in early April. Since that time, risk assets have really rallied as the market has responded less to headlines and continued threats of tariffs from Trump. Those tariffs have ultimately proved to not be as penal or as bad as was originally feared because Trump has walked back a lot of those tariffs. In that environment, corporations have been able to continue to post really good earnings. As you'll see from the chart on your screen, You can see from the squiggly lines there, that's sort of the consensus estimates of what earnings would be in the S&P 500. And then the bars are the actual earnings reported in Q1, Q2, and Q3. And you can see those squiggly lines for Q1, Q2, and Q3 all went up dramatically as the actual earnings were posted from companies. And much the same is expected to occur here once Q4 earnings are released in early 2026. Inflation has certainly cooled, and while it's at 3% in the United States and it's about 2% in Canada, those inflation rates are much more digestible than what they were a couple of years ago. And so the rhetoric from central banks and policy from central banks has shifted from tight monetary policy a couple of years ago when interest rates were quite high, and they've clearly seen progress on inflation, so they've become more comfortable with cutting interest rates. In that environment of lower interest rates, that's a good thing for PE multiple expansion on stocks, which is what we've seen, from about May to now in 2025. The market has expanded. PE multiples have expanded on really solid earnings, number one, and then number two, lower interest rates. And so going forward, what central banks are going to be looking at is, like Kevin mentioned, growth. Like, how is the economy actually growing? If there's signs of weakness, maybe these tariffs do eventually bleed more significantly into the economy in 2026. They'll be prepared to cut rates a little bit further should that be warranted.
It's really hard to say right now what could upset this happy market that we've been seeing in 2025. Whether it could be that tariffs finally start to show the negative implications as they filter into the economy. We really haven't seen them have major effects on inflation ticking up, so that is something we'll be monitoring into 2026. Maybe the euphoria surrounding AI stocks begins to wane as they've been experiencing high growth throughout the year. Or maybe just a good old-fashioned economic slowdown. But at the moment, the markets have been very positive. Corporate earnings have been positive, and that's something that we continue to monitor into 2026. Fund managers and ourselves haven't really seen any red flags that would cause a concern. But again, it's just something that we continue to monitor. But 2025 has been great so far, and we look forward to that continuing. If you did want to take a deeper dive into your portfolio, Harry, David, or myself are here to take your calls.
Take care.